Hello traders, thank you for watching this week's technical outlook video here at xm.com. It's Monday, October 9th. I'm Christina Bartenido, investment analyst, and at this video I'll share my view on dollar yen since the US CPI inflation data are on the calendar this Thursday. In the same day, the UK will publish its monthly GDP growth figures for August, so pound dollar could be another important pair to watch, while in other markets, oil prices will be definitely under the spotlight following the unexpected deadly conflict between Hamas and Israel, which has increased supply risks in oil markets. So starting first with dollar yen and the US CPI inflation data, analysts expect a softer headline CPI print this Thursday. But overall, for the US dollar to resume its uptrend, we need stronger inflation prints, which could consequently boost the rate expectations before the year end. So if that happens, if we get stronger than expected readings, that could help dollar yen to retest the 150 psychological mark, where this dashed ascending line has been acting as resistance over the past few sessions. Then slightly above that, the 150.75, 151.35 region are including those ascending lines as well, and that could be, we may see some noisy trading here before we reach the 151.93 level where the price peaked in 2022. Well, actually, what we need is a durable move above this long-term ascending line in order to reach this steeper resistance line at 155.50. Now, from a technical perspective, well, if we look at the technical indicators over here, bullish signals are very weak, I can say. Basically, the RSI is still in a range, slightly above its 50 neutral mark. The stochastic oscillator is trending down, and the MACD is slightly below its red signal line. So bullish signals seem to be very weak at the moment, suggesting that a downside correction could still be possible. But selling pressures could only come into play if the price falls below the 20-day moving average, which has been acting as strong support since the start of September. Then a break below this lower dashed ascending line at 148 could cause a steeper decline down to 146.60, where the 50-day moving average is placed. Now, if the sell-off continues from here, then the price could retest this constraining area around 144.80 before it seeks support around this support trend line from March, currently seen at 143.40. Now turning to pound dollar and the UK GDP data, expectations are for stronger GDP data. So whether the pound could react on this news, that remains to be seen, because last week's upward revision in national GDP data for the second quarter have barely provided any gains to the British pound. So there might be muted reaction to this week's data as well, but still an improving economic picture could still add some footing under the British pound. We can see that the technical indicators over here have been trying to recover lately, so there's potential for bullish continuation. We may see this rebound. We may see a continuation of this rebound, but for that to happen, we need to break the 1.2235 level and move above the 20-day moving average in order to reach another barrier at 1.2340. Higher than that, some consolidation could develop between 1.24 and 1.2430, where the flattening 200-day moving average is placed. And then perhaps another tough battle could take place around 1.25 and closer to the 50-day moving average, which we need to break in order to become more confident that potential recovery could gain more legs. the way higher could be rocky. So if the price, for example, fails to close above 1.2235, I expect a pullback to 1.21. Failure to hold here could send the price down to 1.1980, where this constraining line from November 2021 is currently placed. While lower than that, I will keep a close eye on the 1.19 level before we target the 2023 low of 1.18. And finally, looking at oil prices, we saw oil prices opening with a positive gap today, rising as high as 87.23. But despite that, we see that the price is still struggling to overcome this broken support line at 85.75. So I would like to see a step above that line before I target the 88.42 and 89 territory, where the 20-day moving average is located. We saw the price limiting bullish actions over the past few sessions, so that could be an important barrier to fight in order to head higher towards the 91.50. We can use this short-term broken ascending line as reference here. That could cause some consolidation before we reach the 93.70 and 95 key constraining zone. Well, if you look at the technical indicators, though, we haven't entered the bullish territory yet. The RSI is still below 50. The MACD keeps weakening comfortably below its red signal line, and the stochastic oscillator has yet to show convincing improvement above its 20 oversold level. So downside risks are still in the market, and downside correction could still be possible, especially if the price slips below the 50-day moving average and closes below the 84 and 84.35 region. Such a move could pressure the price down to the 81 level. This is the 50% Fibonacci retracement of this latest up leg to 95.02. If selling pressures persist here, then the next target could be the 61.8% Fibonacci mark of 77.73 and the 200-day moving average. So that's all for this week's technical pairs that might be important to watch this week. Thank you for joining this session, and see you next time. Bye bye for now.